Are you ready? The time has come. Let the show begin. 5, 4, 3, 2, 1, 0. Are you ready?
Hello and welcome to today's episode, which is going to be very exciting. I'm sure you saw what is going on in the market today, and you're well versed with all the challenges. So today we have with us, of course, Sarab and all those people who tuned in last week. We were preparing for a very extremely challenging topic, and we thought we have to share this with you and discuss about this topic because this is in everyone's mind. So we have today with us Sarab Luther, and let me invite her to the stage. Welcome, Sarab, and today's topic is mortgage insurance. Mortgage insurance, bank versus broker. Ooh, that's so hot, hot. Welcome, Sarab. Oh, you're muted.
And yes, when we were talking about it, you and I, we were discussing, and you really want to focus on this. So here I am with my 2 cents of knowledge, whatever I can share.
So, Sarab, I know we were talking about this very pertinent topic because it's in everybody's mind. Most of us have homes, and there are many people who want to have those homes. People say it's a buyer's market. Some people say it's a time to watch and see. Some people say, be careful how you get your mortgage. So, very pressing. And also, all those people who were actually doing some investments, they are in also double minds or triple minds where to invest, whether to invest in Canada itself or not, maybe think somewhere else. So, please do tell us something about ownership. Who owns the insurance?
So before we go ahead, you touched base on a little bit on real estate side. So we will talk about that. So I believe like they are not making any more earth. So what we have is what we have. There's no new inventory being built. Yes, the new inventory will come in the form of houses, apartments, townhouses, and bungalows or other types of buildings. So talk to your own advisor, talk to your own realtor, and see if it is a good advice. And your scenario, just be an open book. Talk to your own advisor on that what are you expecting when you want to invest. But house is one of the biggest investments of a person's life. So we need to protect that. That is, everybody has this mindset, okay, I bought a house, I need to protect it in case the inevitable happens at a certain a time, like when I'm not expecting it and the inevitable happens. So mortgage insurance usually you will say it's like from banks with the not only bank, so whosoever is a creditor, it's called creditor insurance. So you have borrowed funds from you took mortgage from bank, you took mortgage from another lender, or it is a private mortgage, you still want to have that security. So when we are talking about ownership of a mortgage insurance policy, when we buy from the bank is the owner. Here we will say the lender. The lender is the owner of the policy. Whereas if you go to a broker outside like me, an insurance broker we are talking about, or an insurance advisor like me, then you own the policy. So the person who has applied, he owns the policy, she owns the policy versus the lender owning the policy. So you understand the rights of ownership. So as an owner, you have certain rights. So once those rights are owned by the lender, you cannot make many changes to the policy.
Wow, that's such an important piece of information. So why is that the bank is the owner, or I mean the bank, which is the lender, is the owner of the policy, versus when you go to a broker, then the person who's really borrowing is the owner of the policy? Why is the bank being, why this difference? I just want to know, curious.
So the lender is giving this insurance because they have to protect their own interests. So they have given out the funds to the homeowner to buy a property. So now their interest should be protected. So that's why they are the owners and they are the beneficiaries. That would be the, I know your next question is coming up, like who will be the beneficiary if you are the owner. But whereas when you go to an advisor, you are not protecting the bank. You're not protecting the lender, you're protecting your family. So you want your family to be the decision maker if the time comes, that what to do with the property, whether to pay it off, whether to continue doing the mortgage installments, or whether to downsize. So that decision has to be made, should be made by your family, by your beneficiaries. That decision, I personally believe, should not be made by a lender who doesn't know anything what is happening with the family.
Wow, that makes so much sense. The beneficiary, that clarity needs to be there, because it's all, because all our other insurances also are linked to it. One and who and you just now clarified what factors determine as to who is beneficiary in either of the cases.
So when it is a lender issued mortgage insurance, beneficiary is the lender because they lender is protecting its own interests. But when we buy a policy from an outside independent advisor, the beneficiary is as per whom the policy owner wants to designate.
Hmm.
That's why I was talking about that it is very important that whom you want to be making the decision for your family, for your children, for your spouse. Do you want a lender, a bank personnel, or the third person who doesn't know any geographic about your family to make the decision for your family, or you want your family to get together and make a decision?
And that comes to the my next question as to the underwriting part, because we get very nervous when the underwriting, even like, oh, how is that going to come out? What, because there are so many questions and so many things. So how do we prepare ourselves for the underwriting part? Because even because when I have been taking mortgages, oh, every time the suspense is there. Oh, it's going to come from the underwriter, and we have given everything, but it's all up to the underwriter to approve things. So please
Yes.
tell us something about this massive part
The
of
word.
it.
So underwriter is a vast word. If you see in my designation, it is CLU, is a chartered life underwriter. So underwriting means making a decision based on the facts. So when we are writing a mortgage insurance, so what we are insuring somebody's health, and we are looking at their mortality, that how long this person is going to, based on the facts we cannot do the judgment, but based on the facts we can do so. Okay, this person, this is the mortality rate we are going to apply. When we are doing an application with the lender, their standard questions are there, and usually the underwriting does not happen at the time of the application but at the time of the claim. So when you come out to an independent insurance advisor, at that point the underwriting happens up front. That means you put in the application today, the medical underwriter will come and they will say, okay, you know what, based on your age, based on your health, instead of standard, you seem to be taking too many medications, we are going to give you a little extra, you will have to pay a little extra. But they will tell you that today, upfront, before you sign up, okay, I agree and I purchase this policy. In a good case scenario, they can also come, and it has happened. Hey, given your age, given your health, you are healthier than your standard person. So we will give you discount. So if there are penalties for not maintaining or not being very healthy, there are also discounts available for maintaining a good health. But that underwriting happens up front. So which is a very beautiful thing, that you know that these are the criteria that has been approved, my application has been approved before I started and signed, not when I am dead and my family needs a claim and then they are pulling out all the doctor's reports to see, oh, uh, at that point this was happening and that was not happening. Though there are claims process does involve some of the checkbacks, but that is totally different from underwriting.
Wow. Thank you again for sharing those information. And it really clarifies your mind. So now, next time, viewers, if you have an underwriting question, you know where to email sarah.ludhar@gmail.com. And I hope today's session is educating people like me who are new to all this. We've been doing this for years, but interestingly, we have not understood the science behind it, how well informed decisions can be made, and how you can also save a lot of money, basically not get into those traps, and
Yes.
and for years, and then you wonder, oh my god, I've been paying, instead we could have paid the mortgage itself with all the amount we have put it here and there. Coming to money, and also every little penny counts, premium is a very important factor when people consider various options. And a question that comes in our mind is, does these premiums change?
Yes and no. So why I said both the answers, because when you are buying a mortgage insurance from a lender, so if you see, though the amortization could be 25, 30 years, but your renewal is maximum 5 years. So you lock in the price for mortgage insurance from the lender for 5 years. So they will revisit the prices after 5 years. So after 5 years, if your mortgage has gone down, the loan amount, your age has gone up, and if you have any medical condition that has turned up, that will affect the premiums. Whereas if you come to an advisor and say, okay, my amortization is 30 years, so we will give you one rate for whatever term you choose: 25, 15, 10, 30, 35, 40, one rate. So during the duration of that policy, the term that has already been set, the premiums will not change. So if you buy a term 20, the premiums will remain same for 20 years. So they will not change in on the way. Okay, this is year 2 now, the client is 2 years older, we're going to change. This is year 7, we're going to change. No. So whatever has been issued, so they remain the same, unchanged for the duration of that policy.
Okay, so that's great news to hear that there will be no changes and it stays the same for the duration of the policy. So if we get a good policy, it's good to stay with that policy. I think
Of
that's what
course.
I hear. Or is it good to shop around in between and see where you stand?
Uh, Talking about changing the policy, life insurance policies are they are not something that you should be changing often. Yes, today an 18-year-old youngster has no financial commitments or liability, wants to go with a small term, agreed. And tomorrow, instead of just going ahead and canceling the policy, see what you can add to it, because you got a great rate possibly at the age 18. So the younger, the better the rates are, and the cheaper they are, and they last you for longer term.
And I think that's what we were talking about, the continuity. But what about when a person thinks, is it better to encash it for selling off to pay off my mortgage, or take that vacation? Is it worth to do those kind of things?
Not with lender issued policies. So lender issued policies are usually term 5. So that means they're valid for 5 years only. There is no provision to build a cash value in it. But outside, we do have policies that you can build cash. You can use that cash value for your however you want during your lifetime. But obviously, we have to understand a term policy will be way cheaper than a cash value policy.
Okay, so term policy will be cheaper than a cash value policy. Both have their own basically perks, right?
They do have. So one, this is like little bit off the topic here, because term policies are for short term financial or a term. This is for some duration of a financial liability. So I always say that life insurance is not only answer to the question, what if I die too soon? Because when it comes to insurance, people usually think, okay, this is an answer to my question, what if I die too soon? Life insurance can also be billed as an answer to a new question, which we often forget. What if I live too long? What if I live after I have paid off my house? My kids have done their university, they are into great job, or they are doing a good business, they are married, wonderful partners, they are living a happy life. Why don't we think about those euphoric kind of situations? Because things do happen, people live longer than their house, their mortgages. So what is happening at that time? What am I building for my rainy day? So
What am
they,
I building for my rainy day? Such an important question. Yeah.
so when I used to train, I would say, I would ask them for a 2 week vacation. This is, we are in the early months of the new year. For 2 weeks vacation that a family is going to take in December, they have already planned where they are going. They have already notified their jobs that, hey, we will be taking these days off. They're already shopping around for tickets. They're already making the plans. Retirement is the biggest vacation. It can last anywhere from 20, 25 to 35, I don't know, 40 years, depending upon when you retire. When should you start making plan for that retirement? So this is an off topic, maybe some
Yeah,
other
right.
day,
That's what I was
but
just coming to
let's
the.
continue with mortgage insurance.
Yes, yes. So one more thing, often I've noticed this is not like in a regular. This is more of an experience. I've noticed that often when you buy a house, and always there is this mortgage person who is doing your mortgage, be it the bank, be it broker. They always ask and say, "Would you like to take the mortgage insurance?"
Yes.
So why would a person take the mortgage insurance versus if they have life insurance, and if they have like if they have already, yeah, like if they have a good life insurance and everything, why should, what is the difference, like what is the need for taking the mortgage insurance? Because anyway, if that person is gone, then the life insurance covers it. And then why would you go and take mortgage insurance? Because then apparently I've heard like talked about many people who came and said, oh my god, after that it's such a big task to get the money out of the from the mortgage insurance. So can you please shed some light into it? What, first of all, what is the need for doing a mortgage insurance and why is it so important?
So, very like this is an amazing question when we are talking about if you already have a life insurance policy, always revisit. So, people would want a mortgage insurance policy. It is also a mortgage insurance policy is not covering your mortgage, it is covering your life insurance. It is covering your life, right? So, mortgage insurance policy, why we say it? Because it will be a term policy. So let's say I have a life insurance of 150,000, so that is going on and it's a good policy. And now I'm buying a house. I got a loan of 850,000. So now the bank will say, hey, you know what? It's only 150,000 of life insurance that you have. You are lacking 700,000 of insurance where our loan is not secure. The family is not secure now. That's the person is thinking, okay, that means the family is not secure because it's only $150,000 life insurance. So that's where you kick in a mortgage insurance. So very important to understand, though we are using the term mortgage insurance, that does not mean when you're talking from the advisor outside. I'm not talking about the lender here, because if a lender is issuing a mortgage insurance, that is will be used to pay the mortgage. But when we are talking about mortgage insurance from an advisor, we are talking about life insurance. It will not be paid towards the outstanding mortgage. The benefits will be paid to the named beneficiary. Now, here is a very wonderful scenario that I would like to share. So, let's say this person bought a house in 1995. They have paid off the house in 2022. Their house is paid off, and they had a mortgage insurance from the lender for the property that they bought. They had a life insurance from an advisor, both 200,000 each. Now the mortgage insurance will not pay because there is no mortgage outstanding. The person passed away in 2022, just last installment was remaining. The mortgage insurance will pay only the remaining last, not the whole amount. The person could be covered for 200,000. But whereas that life insurance will be paid fully, irrespective whether your mortgage outstanding is $0 or whether your mortgage outstanding is $500,000. So at 200,000, if it the life insurance policy is 200,000, the family, the beneficiary will get a check of 200,000. This is having said that, we also need to consider the the whom you can insure. So now, for whatever reason, one of the partners did not qualify for mortgage. So often the bank or the lender will come, you know what, Mrs. qualifies, Mr. does not qualify, his credit history is not good, so we cannot put him on the application. Now the mortgagee here is Mrs. So when you go to the lender will give you mortgage insurance only on Mrs. because she is on the application. Whereas if you come to an advisor, so advisor can give you insurance on Mr. and Mrs. So you can choose the lives that you want to cover. So now your mortgage is only 400,000, for example, but you say, you know what, I want to have a round figure. I want 500,000 of insurance. So lender will issue you only 400,000 of coverage because that is what is at stake. But if you come to an advisor looks at the whole picture. Okay, this family has a mortgage, they have younger kids, they have a line of credit, they are young, there's an old parent, there's a disabled sibling, something. So we take a holistic picture and then we say, you know what, this is what you need. Now let's do what we can do.
Thank you. Thank you for sharing that. So, my one more question, very small one. I just wanted to ask was mortgage and mortgage insurance, are they done under the same umbrella or they are different people?
No, no, different people. Mortgage is done by the mortgage advisors. In mortgage insurance is done by insurance advisors.
Okay. And that brings me to the next question. Renewal is another very big this thing. Here we think, oh God, 5 years are done. My mortgage was all good. Everything now the rates are going to be too high. My rate is going to go high. How am I going to manage this? So does that? And you said that about the premiums. I think stays the same or throughout. So that
Yes.
should not. But in can my coverage be cancelled by someone other than me? Because what happens is when you're switching or we
Mhm.
are thinking of switching, can the somebody just cancel the insurance?
Wonderful question. So when the mortgage renewal comes, we want to shop around to get a better interest rates. So yes, once you change your mortgagee, your lender, sorry, not mortgagee, your mortgager, and your lender, the policy that was issued by that lender automatically cancels. Whereas the policy that you have purchased from us, from an outside insurance advisor, that doesn't care whether your mortgage is with RBC or Scotia or with a B lender or a C lender or a private lender. That is, and they don't cancel it. So life insurance policy is a unilateral contract. That means once everything has been approved, the policy has been issued, the company will not cancel the policy unless and until the premiums are not paid or the company finds out that there was some misrepresentation that happened on the policy. So if the company will cancel the policy, it will be based on some fact, not on the basis that, hey, you changed the lender, you had a mortgage with RBC, now you moved to Scotia, so we are going to cancel your policy. No, that doesn't happen. But when we have a lender's protection, that's what happens. So you lose the coverage if you change the lender.
Thank you. That was great. Thank you for answering those questions. And as we move on in this program, I want to also let the viewers know that you can ask a question live. So when you're watching this program on Facebook, on YouTube, I'm sure many of you have the link. Otherwise, we will going forward. We will share the link in advance so that you can be part of this live broadcast. All you have to do is write the question in the medium. So if it's YouTube, you just put a comment there. On if you're putting on Facebook, you can do the same, and we can bring your question right live in our program. Also, you can ask the advisor, our advisor, my advisor, any question that's burning and you have that deadline coming soon. So please do reach out. There's an email that we have been displaying. So please contact sarabludher at gmail.com. Very simple, sarabludher at gmail.com. And also you can reach out for any further questions, any assistance. We are always here to help you and take your questions. Burning questions are important for discussions, and we will bring in these similar questions to you. To as far as even me, I have not from this field, but I feel so enlightened and empowered by knowing some of these answers. This will help me take better decisions in the future. I wish I had a very frank, honest discussion before I made those important decisions. Every single person, doesn't matter if they are 18 or 80, they have the right to know. Right to know is very important because that will help you make those informed decisions and then you don't play the blame game. So, Sarav, what are we thinking of doing next week? Have you any thoughts, or should we leave it to our viewers and they can tell us what we would like to speak and discuss going forward?
So going forward, like next week, I want to talk about RDSP, which is very important. It is Registered Disability Savings Plan. This is it's close to my heart. The children, especially the people who are on disability and they are qualified for disability tax credit. So as they know that the banks have RDSPs where government matches each dollar by up to $3 depending upon their finances. So you invest $100 and government will give you $300 into that. Just to share, one of our insurance companies has come up with RDSP. They have introduced RDSPs into our product portfolio. Why I'm so excited about having this? Because we want to have their future safe. So there are people who will outlive their caretakers. So what happens when a person who is on disability and is dependent upon a caretaker, but that caretaker passes away? So it is very crucial that we start talking about this and we start planning for this. Because I heard somebody in a meeting that this is like disability is the next pandemic that is waiting to happen. So let's be prepared. We know somebody who is either a child who is challenged, who is special needs, and not only children, some adults, some seniors. So anybody who's qualifying for disability tax credit, we will talk more about like how they can make use of this government's grant and funding. It is just for the disclaimer, just one thing, that only people who are under 49 years of age will qualify for the grant. So we will talk in details next week. If you have any questions in the meantime, you can always contact me at saurabh.ludhar@gmail.com. You can leave a comment on this live, which will be available even later, and we will definitely get back to you. And your information is always kept confidential.
Thank you. That was great. And I think everybody has taken down the email. I'm going to share the little note that we all discussed today. So if you want to take a picture of the thing, or we will share if with our on our post with a very more fancy slide. But I think all the points that we discussed are right here. I just want to put it for a minute. And thank you so much, Sarah, for coming in today and sharing all your thoughts and everything, and also discussing such an important topic.
Thank you, Malika, and thank you, all the viewers. Looking forward to seeing you all again next week.
Are you ready? The time has come. Let the show begin. 5, 4, 3, 2, 1, 0. Are you ready? The time has come. Let the show begin.